comes today. This is for anyone looking to purchase a home and purchase a home with little to no money down and/or let me see here. Make sure my microphone's going well. And it's such a great opportunity for anyone who is looking to purchase a home with little to no money down. It also gives a lot more purchasing power to the buyer that may have been priced out of homes 3-4 years ago. This is something that I believe is super beneficial to anyone who is looking to purchase a home in California for anything around 950,000, maybe a little more down, and have some support in qualifying. And we're going to get into it right now. I'm going to go ahead and share my screen. Okay, so jumping into it, I want to first go into the California Dream for All rates, and then we'll go ahead. CalHFA rates. And then we'll get into the handbook. Let's see. CalHFA rates. We'll just search for that. Excellent. So the rates for the California Dream for All program is at 6.25% today. And then it is at 6% if you're at the low AMI, 80% AMI or lower. We'll go ahead and click on to the California Dream for All loan program handbook. Now, this one not only includes the California Dream for All, but it also includes all of the programs that they have access to, or we have access to, and that is the Cal Ready, CalHFA conventional, as well as the Cal Plus and the Cal Access loans. Personally, I only do the Cal Access and the California Dream for All because those are the most rewarding. The Cal Access gives down payment assistance and closing cost assistance. California Dream for All can be structured that way, and we'll get into that in a second right now. Okay. CalHFA conventional loans are a Fannie Mae product. Okay, it's Fannie Mae preferred, and you can see it right here on the CalHFA Dream for All conventional. This loan may be combined with California Dream for All shared appreciation loan. This is something that happens in pricing. We'll go with the Fannie Mae first, and then CalHFA Dream for All will do the next. The borrower eligibility requirements are: you must be a natural citizen or a qualified alien, defined in this code, meet credit, income, property, borrower, and loan requirements detailed in this program handbook, as well as CalHFA Lender's Manual, Fannie Mae, and CalHFA Approved Lender, the mortgage insurer, and the CalHFA's Master Servicer requirements. And you must be first-time home buyer. All this information is something that we take care of. It's not something that the borrower is, of course, required to give us a credit, income, property, and other documentations to qualify. But it is something that we organize, work through, especially with CalHFA, their servicer, and so be it. The exception to a home buyer first requirement, we're not going to get into that one because it's not relevant to the California Dream for All. Home buyer education, you're going to need a home buyer education. If it's not done within the year, you're going to have to retake it. Okay, there is no extension on the California Dream for All home buyer education. You have to take it every year. So if you took it 2 years ago, if you took one a year and 1 month ago, there is no extension. I've tried it already. It's not something that we can go. We typically try to get eHome. So if you took it with eHome like a year ago and it's still coming up with your previous account, then you're going to have to redo another account with another email and go through the process again. It's $150 for eHome. There are other places that you can go to, and they have approved housing counseling agencies right here. There are free options, but with the free options, they sometimes take time. Sometimes they'll do a training on Saturday for half of the 8 hours required, and then the other half 2 weeks later. And if you're in the process already, then that's not going to work, right? So you want to get prepared for this and make sure that you take your home buyer educational process before it opens up in February. Okay. Additionally, Dream for All conventional requires borrowers to complete this special homebuyer education specifically for shared appreciation loans. What they want you to understand is that you're going to be sharing the appreciation of the property. So if it goes up $100,000 in value and you're looking to refinance or sell the property, you're going to share 20% of those proceeds with the CalHFA shared appreciation loan, as well as the amount that you borrowed initially. Okay, so this is like as if you're becoming a partner with California to purchase this property to live in, but it's a property you wouldn't necessarily be able to qualify for unless you had this loan. So it's very advantageous. It gives so much purchasing power because you're not qualifying off of the sales price minus like the normal down payment of 3% for first time home buyers. You're qualifying for the property with just 20% taken out of the LTV. So you're only qualifying for 80% of that for most properties. When you get up into the 800s, 900s sales price area, it's not quite 20% because it's either 150,000 or 20% down payment. First-time home buyer definition is to qualify for a CalHFA conventional loan program. With a subordinate loan, all borrowers must meet the definition of a first-time home buyer. For this type of loan, it's actually first-time generational home buyer, and we'll go over that in a second. A first-time home buyer is defined as a borrower who has not had ownership interest in any principal residence or resided in any home owned by a spouse during the previous 3 years. Okay, now first generation home buyer definition is to qualify for the California Dream for All loan program only. At least one borrower must meet the definition of a first generational home buyer. Okay, so it's just got to be one buyer, but they both have to be first time home buyers. First generational home buyer is defined as a home buyer who has not been on title, or held ownership interest, or been named in a mortgage to a home on permanent foundation or own land in the United States in the past 7 years, and the best of the home buyer's knowledge, whose parents, biological or adoptive, do not have a present ownership interest in a home in the United States, if deceased parents, whose parents are deceased, did not have any ownership interest at the time of death in the home, in a home in the United States, or an individual who has at any time been placed in foster care or institutional care type of home residential care for large groups of children, non-related caregivers. So if you've been in foster care, they want to know your foster information, make sure that they don't own a home currently. Owner occupancy. All borrowers must occupy the property as their primary residence within 60 days of closing. Non-occupant co-borrowers are not allowed, and non-occupant co-signers are not allowed. So we can't have co-signers or non-occupying borrowers on the application. So no one can aid you in qualifying for the loan unless they're going to live there. Property requirements. Eligible properties are single-family residence only. Okay, so I don't even believe that the California Dream for All will do an ADU, but it does say here that it does. Single family residence is a one unit residence. Accessory dwelling units, ADUs, guest house, granny units, or in-law quarters are eligible within the following parameters. The property must be defined as a one-unit property. I don't understand that, because typically it qualifies as a two-unit property, or rather ADUs make it a two-unit property. So it's possible that they don't give this distinction to ADUs. But when I look at other loans and lending, we consider it as a two-unit most of the time. Multiple accessory units are not permitted, so you can't have more than one ADU, and must meet investor guidelines and city county ordinances. 4 is per investor guidelines. If a rental income from an ADU is used for credit qualifying, CalHFA will use the gross rental income for compliance for the compliance income calculation. So oftentimes you can use, if you're purchasing a property with more than one unit, you can use the other unit's rental income to qualify, less 75% of the occupancy ratio, because it's very often that you will have to worry about renters leaving and then re-renting it out, and that could be about 25% of the time it's not occupied. We consider that into the factor of the income, and then it only offsets the payment. So if you were able to rent the property for more than the property, then more than what you're borrowing, or sorry, if you're able to rent the property more than what your monthly payment is, they're not going to give you income to qualify. They're just going to offset the payment for that, unless you have, you wouldn't have as a first-time home buyer, rental management thing. Maybe if you worked for a management company, that would be something to definitely consider if that was going to be the issue. Okay. Okay, so manufactured homes are permitted for FHA. If you wanted a manufactured home, you could do single wide. You can't do a single wide. Fannie Mae desktop underwriter is approved only, and your maximum DTI is 45%. This is something that you're going to definitely be. This is something that you're definitely going to have to worry about in my what do you call it? In my opinion, because 45% DTI limits how much you can qualify. With these programs, it is an upfront, what do you call it? A front end ratio of 45%, but you have like your car loan or other credit cards that you might be having on your credit, and those can raise your DTI on the back end over 45%. So it's more advantageous to have a 50% back end ratio requirement than it is that 45% back end ratio requirement. We'll get into that, basically how that is important and relative to you. But basically, the front end ratio is just a housing payment, and that is the PITA, the principal and interest payment, your home insurance payment, your taxes, your mortgage insurance payment, and then your association dues if you're dealing with homeowners associations. That's what we call the PITA. Then you also have your back end ratio, which includes your housing payment, but also any other debt. So any any school loans that you have, any installment loans, any revolving debt, which is credit cards, all of that is going to be totaled up, and it can't be more than 50% of your income. And we call that your debt to income ratio. Leaseholds are not permitted. Okay, so you have to own the land as well in order to qualify for this program. Appraisals for appraisal for mortgage manufactured housing advantage requires a picture of the MH Advantage sticker. Typically, there's a sticker that will be on the single wide, double wide, or triple wide that you're looking to purchase. And I believe that this is the kind of sticker that they require. Of course, if you click on this, it doesn't. They can't find the page. So I was like, oh well, kind of silly that they even put it there and give us a bad link. Anyways, loan program. It's typically 97% for the MH Advantage, and then 95% for the standard, what do you call it, manufactured home. The max CLTV on this is typically 105. This is going to be important later, but we'll explain it. The highest that we can do, we can finance this at is 105%. I typically take these loans to 105% because I find it super advantageous for the borrower to not have to come in with any closing costs. Okay. Most of my borrowers who go with the CalHFA Dream for All don't pay their own closing costs. They just come in with the deposit, they pay their inspection fees and their home buyer education, and that's it. I even try to get back their appraisal fee and their home buyer education money back, if that's, of course, a goal for me, but I use some of the money. Yes, they're going to incur what is called mortgage insurance, but the mortgage insurance is like sometimes $40, right? So if you're going to borrow $26,000 to $50,000 for closing costs, and only pay $40 to $100, I mean, let me know where I can borrow 26 to $40,000 for only $100 a month, right? It's a no-brainer. And most of our clients are cash sensitive with this loan, right? So if they're trying to qualify for this loan, they don't have much money in the way of reserves, right? So when you purchase a property, often cases that you're going to want brand new furniture, you're going to want to be prepared for any repairs that might happen. Many people, as soon as they purchase their home, is going to be like 6 months down the line, the dishwasher doesn't work anymore. What are you going to do? You already spent all your reserves in purchasing the home like 6 months ago. You're trying to build back up, and you won't have those type of reserves. That's why a home warranty is always important to get, but hopefully you get a good one, because if not, then they're always going to try to deny, and I don't want to get into that rabbit hole. But if you need a good homeowner warranty, I have a great lady that could set you up with that. Okay, leasehold estates are not permitted with manufactured homes. All leasehold estate documentation must be submitted to CalHFA Master Servicer with a purchase package for review on approval. Now, they're going to talk about this Master Servicer a lot. Basically, we package up a loan product, it gets through underwriting, and then after it's been underwritten, that lender is then going to go send it over to CalHFA to approve, and then they're going to go through another underwrite. That's why many people prepare for the CalHFA Dream for All as a 45-day process, but we don't do that here. We're at 30 days or less for this loan. The last one that I closed all of these on time. So if we need an extension because of unknown circumstances, that's typically not on us. It's typically like on an HOA or some other reason why we couldn't close a loan and needing an extension. It's not something that we're actually responsible for, but it does come to, like, it comes to reality that if there is extensions, it's not going to be on us. We package these loans so well, and we know how to get through the CalHFA process very, very conveniently. It's 30 days or less for us. Other lenders, just be worried about other lenders. But if you want to come to the best one for CalHFA, you know where to go. West Shores Financial. Community land trusts are accepted through Community Land Trust Network. All CalHFA documentation must be submitted to the CalHFA servicer. Purchase package for review and approval. Again, we get it underwritten by the lender. They send it over to CalHFA. Then the CalHFA servicer signs off on it and sends it back. Now, if there's any adjustments that happen when that comes back, you're going to have to resend it back to CalHFA for review. So that's why it's important to get it done right the first time correctly, and then send it over. If there's any extenuating circumstances that happen during the process of the loan, then that is something that that must be done. But we typically make sure that it's a one and done type of thing. Okay, this is a community land trust. I'm not even sure we can do that with California Dream for All. So I'm moving over to underwriting and compliance. The transaction type is purchase transactions only. They do a lot for these are the income limits. They do a lot for a refinance for the California Dream for All. So the California Dream for All refinance is going for 6% right now. So as rates adjust down, you will have an opportunity to refinance this, I believe, one time with CalHFA, and you'll be able to refinance it for the rates that go. Everyone has access to these rates. All you have to do is go to CalHFA, just search CalHFA rates, and everyone has access to these rates. I can't give you a better rate than what is on the website itself. So it's the same rates for everybody, okay? Term is 30 years. Loan program type, all loans must be Fannie Mae HFA preferred. And then a home energy is also allowed. These are like home energy efficient homes that we have in California. They are allowed here. The loan to value cannot exceed 97%. And then the combined CLTV cannot exceed 105%. Okay. Now, so and we'll get into this in a second. Combined loan to value is between 95 and 105 for the Dream for All conventional loan only. So you can't use all of the proceeds or the down payment assistance for closing costs. You need at least 5% to use for closing costs. Of course, that doesn't really come into play with the valuations that we're dealing with. And we can get into that in a little bit later. But just understand that you're going to put at least more than 5% down for your down payment. And then you can use up to 5% for closing costs. And yeah, I don't think that there's any conforming limit that would allow you to use less than that, because your maximum is, let me see if I can just pull it up here for a second, calculator. So your maximum is 150,000. And in order to get conforming, you would have to be at 830. So let's see, 830 plus 150. You'd be at 980, and then 830 would be 84%. You would still have mortgage insurance, and if we were to bring it to 95, so like the numbers are to the point where 980 123 times 0.95%. That would be minus 980. And I know this is boring, so you would have to use 100,000 in closing costs in order for that not to make sense. And it doesn't make sense because you're at 980. So it's very improbable that you would have 95% down payment, or sorry, a 5% down payment and still have a 5% CLTV. That's not important. Maximum loan amount. The maximum first mortgage loan amount cannot exceed the current Fannie Mae conforming loan limit, and that is at 832 or so, like 832,000. So with this loan, if it is at that, that 832 mark, so 832,000 plus 150,000, which is the maximum, you can only go for a home that is right around 982,000. But then now you're coming in with your own closing costs. So if you have the closing costs, you save some money, but you see the property at 982,000, you can take the maximum benefit. Just understand that you're going to end up paying for your closing costs, but then you're only qualifying for 832,000. You're purchasing a home at 982,000 for only 832,000 to qualify. And that gives you so much purchasing power. So it's an amazing program, and I'd love for everyone to go for it. Let's see here. Also, okay, so that's the maximum loan amount that you can go for. The maximum LTV or high balance loan cannot exceed 95%, and income cannot exceed CalHFA income limits. So the income limits are over here, and your income limit is limited at 211,000. Okay, no, it looks like we're actually at 200, or we're actually at 168,000 for the California Dream for All shared appreciation loan income limits. Okay, so we're at 168,000 total for the household. All right. Income limits requirements. Lenders are required to calculate income to qualify borrowers for loan approval using the Fannie Mae guidelines. CalHFA will use lender credit qualifying income to determine if the loan exceeds the maximum program income limit. Income not used by the lender for qualifying or for credit qualifying will not be used by CalHFA. Use the Fannie Mae's Home Ready lookup tool to determine if the income is less than the area median income of 80%. This this gives you the ability to get a lower interest rate. So if you look at the interest rates right here on the CalHFA Dream for All, you will see that it is at 6.25 for regular. But if you have 90,000 or less in Los Angeles County, 90,000 or less in income a year, you qualify for this lower rate, but then you also qualify for better mortgage insurance as well. Alrighty, all borrowers must still meet CalHFA's income limits. Qualifying ratios, maximum DTI cannot exceed 50% with credit scores greater than or equal to 700 FICO score. So it's important that you have great credit going into this. 45% for borrowers that are less than 700. So we're looking at like 680 being the 680 being the absolute line for this. You're going for a conventional loan, and the conventional loans, their minimum FICO score are at 680 for this. You're looking at a 45% back end ratio and a front end ratio to qualify. Again, this makes it harder to qualify, in my opinion, because typically people have bills attached to their credit, which is like a car loan. It's very common for a car loan, student loans, and some credit card debt. If you do have that, then you're unable to maximize your income to qualify for a property. Whereas if you have this 700 FICO, we can take it up to 50, which leaves you room for a car payment, maybe some credit cards or student debt. Minimum credit score. Minimum credit score of 680 for borrowers at income that are greater than the 80% AMI limit. So I take back that it's the 680 limit. It looks like it's 660 for anyone who's making $90,000 or less in Los Angeles County. If it's a county outside of Los Angeles County, it's your area median income of 80% or lower. You can qualify with a 660 or less. Mind you that you are going to be at that 45% DTI. Borrowers with no credit score are not permitted. Non-traditional credit is not accepted, so we won't consider utility bills, phone bills, or any other type of non-traditional credit lines. All borrowers must meet the minimum represented credit score requirement. The middle score of the lowest score borrower must be used to determine eligibility, and it's done by a tri-merge credit report using the middle score. If the merge credit report only returns 2 scores, we use the lower of those 2 scores, and if the credit report returns only 1 score, that score must be used. So, what does that mean? It means that if there's two borrowers, one borrower, one co-borrower, we take the lowest score from them. And then we use the middle score from TransUnion, Equifax, or Experian. Okay, those 3 bureaus are third-party bureaus that make critical judgments of you without your permission. And they also give these scores out independently to whoever they wish and whoever buys this information. They score on you, and you get 3 of them, and we'll take the middle of them. If you only have 2, we take the lowest of the 2, and if you only have 1, we must use that 1, and we use the lowest of the borrowers. Automated underwriting, acceptable underwriting system. We are using DU with Fannie Mae. Fannie Mae is DU. It is with the HFA preferred, must be selected in the community lender product field. This is an automated underwriting system. It's the first automated underwriting system. You do have to be approved with our automated underwriting system, which is called DU, and it is necessary for you to acquire the loan. CalHFA subordinate loans must be entered into the community seconds. Okay, it is a community second. Freddie Mac, Loan Prospector, and other customized automated underwriting systems are not permitted. Loan Prospector is actually old. It's called LPA, which is Loan Product Advisor, I believe so. But it's called LPA now. It's with Freddie Mac, the other the other GSE, government enterprise that provides liquidity into the market. We won't go there, but that's what they do. They make sure that whenever you want a loan, that there's money ready for you to get a loan. Miscellaneous Lakeside loan servicing underwriting guidelines. Let's see. Lakeside will not purchase a high cost loan. So you can't. There's a certain amount of costs that are too much. I believe in California it's 6%. It might be a little bit higher than that, maybe around 8%. But you're unable to just rack in costs like, oh, I want to pay down my rate 3 points. Okay, but that's going to cost you $20,000 to do that. They won't allow you to do a high cost loan. That essentially makes it much more expensive to you, and it's probably of little benefit to you. Underwriters should make sound credit decisions, assure data integrity, include all necessary documents in support of the underwriting decision. There's no arm length transactions must be. Oh, sorry, my bad. Non-arm's length transactions must be fully disclosed, so they must be disclosed on that. Appraiser must meet all of the master servicer guidelines. UCDP submissionary support reports, both from Fannie Mae and Freddie Mac, are required. So this is something that the appraisal will need to include. 2-to-1, 1-to-1, and 1-to-0 temporary buy downs are permitted as Fannie Mae and master servicer guidelines. I don't really see these in California Dream for All products, but if they are allowed, it is novel to me. There is a way to do a permanent buy down, and that's typically 1/8 of a point costs a half a point. Mind you, there is a headroom there where you can't just buy it all the way down by 3 points, because of course the high cost comes into play, right? So there's a limited amount of buy downs that you would be able to do. Loan must be credit qualified at note rate. So if you get a temporary buy down, it has to be qualified at the rate that you are buying it down from. Okay, temporary buy downs must be disclosed on the final CD. Buy down agreement must be forwarded to LLS prior to loan purchase, meaning that it's got to be sent to the servicer to be reviewed before the loan purchase, before it's sold off into the secondary market, which is typically packaged up into mortgage securities and then sold off. Buy down funds are net funded by LLS at the time of first mortgage purchase. All loans are subject to audit by both CalHFA and LLS. So it's going to be audited. I've had my loans audited before. I welcome it. I just, if this comes down the line, if they ask for something, just give it to them. If you give loans above board, meaning that you're always honest and you're always disclosing and doing all of the correct things, you're going to run into an audit every once in a while. No biggie. Just give them what they need so that way they can complete the process and move forward with the loan. Typically, it does happen to me. I think it's happened to me once before, and we just went ahead and moved forward. It did take an extra day for them to audit the profile, but there's no biggie. Mortgage insurance. Mortgage insurance required for all the loans above 80% or 80.01% LTV or higher. Okay. Most of my California Dream for All programs that I've serviced are above 80%. So you are going to be mortgage insurance required, but that's because I prefer to support these borrowers with no closing costs. I believe having no closing costs supports a borrower who is cash sensitive more than ever, and you're saving so much money from the large down payment. It's like a no-brainer to me. I know that a lot of people probably just go and opt in for the 20% down and having no mortgage insurance, but when you price out the mortgage insurance, it's really not that big of a deal. And I think it's more supportive to the borrower to have cash reserves than it is to just go for that that vanity matrix of having 20% down. It doesn't make sense to me. But again, if the borrower chooses, because it's always their choice, they're the boss, always, to go with just a straight 20% down, I'm more than happy. But after they've seen me edify the no closing costs option, they tend to go with that because it is very much insulating against whatever could happen and secure. Mortgage insurance must be ordered through mortgage insurance company approved by Fannie Mae. That's a process that we do in the back end. Per DU findings, borrowers with income less than or equal to home ready 80% AMI LI income limits are eligible for half a preferred charter, MI discounted coverage, and MI rates. If you're at that 80% AMI or lower, which is Aryan median income or lower, you're going to get preferable treatment. You're going to be having lower rates. You're going to have a lower mortgage insurance, and you're going to qualify easier with this program. It's just something that we really want to do. We want to support people who are looking to change their life, who are looking to take a part of the California Dream for All and purchase a home, who happen to be in that lower tier of income. Borrower paid monthly, split premium, or single premium mortgage insurance is acceptable. So you could basically, and I typically set people up with a borrower paid monthly. Split premium is you pay off a lump sum, some of it, like half of it, and then you pay monthly on that. And then a single premium mortgage insurance is you pay the full lump sum of the mortgage insurance up front. I don't normally do this. I think it's best to go borrower paid monthly and just deal with that. There's no reason to move with this, but of course, it's always their choice. But I tend to recommend going with the borrower paid monthly option. Finance mortgage insurance premiums must be included into the LTV or CLTV. So if you finance the mortgage insurance premium like a single payer or a split premium, then it's something that you have to be included into the CLTV or the LTV. CLTV means that you'll have less to be able to use towards closing costs, in my opinion, and then it's also going to raise your LTV and increase what that in premium is. Impounds. California, CalHFA requires all first loans to have impounds regardless of the loan to value. So it's not an option for you to pay your taxes and insurance separate from your mortgage payment. It's all going to be all inclusive. So you are going to create an impound account. Part of the closing costs that I finance through the loan is actually going to go in there into an account for you to pay. So so if you can consider this, some of the closing costs that we are using to pay for this from the loan are actually going to pay your taxes and your homeowner's insurance. So it's pretty exciting. Basic home protection, you are going to be required to get a 1-year home warranty protection policy, and make sure they pay out. There's a lot of ones that don't. I have a good person if you're looking for a referral. Exception to home warranty, borrowers purchasing a new construction and property, or borrowers are not first-time home buyers and they're not using my home. This isn't going to be you. This isn't going to be you. It might be possible that you do get a brand new construction. I still say get the home warranty. I've seen a lot of horror stories about new construction, so make sure you get your home warranty. That's just my opinion. Okay, it's not. Don't say that. Well, he made me to do it. The home warranty must cover the following items: water heater, air conditioning, heating, oven, stove, or range. Home warranty must be disclosed on final disclosure, or a copy of warranty coverage will be required. It will be required. They will ask for this. They will want you to send it over to your lender, and then we will forward it to CalHFA. Subordinate financing. Again, the My Access program is an amazing program. We can go over that some other time, but we're talking about the Dream, baby. So the Dream for All shared appreciation loan can only be used for Dream for All conventional. All borrowers must be a first-time home buyer. So it's only a conventional loan product. It's not an FHA product. FHA products come with higher mortgage insurance anyway. It doesn't make sense for this program. There are easier terms, like meaning it's easier to qualify for an FHA CalHFA loan, but they're not allowing that for this program, and rightfully so. It wouldn't make sense in my opinion. Okay, so conventional only. All borrowers must be a first-time home buyer. They must be first-generational home buyer. One borrower must be a current California resident. So the co-borrower can come from another state and not be a resident here. May be used, but they got to live on the property. Okay, so they got to live on the property. May be used for closing costs and or down payment assistance, like I've gone over multiple times this time. A lot of people don't understand. A lot of your lenders that are going to pontificate about this program don't understand how to structure it so that the closing costs can be used, or this down payment assistance can actually be used for closing costs. So come to a professional who knows what they're doing. Okay, even if it's not me, make sure that they know, or at least forward them this information so that way they understand that they can use it for closing costs up to 5% of the CLTV. Okay, cannot be used for debt payoff. Okay, so we can't pay off for debt. So oftentimes they're going to require a $3,000 deposit from you to make sure that you're serious about purchasing the home. That's just how offers go, to 1%, maybe even 3% of the purchase price of the property. Now, I tend to use that to qualify if I need to pay off debt to qualify. So I will still be able to use the closing costs to pay for the closing costs, and then use that $3,000 to $5,000 or 3%, however much you put down as a down payment, or sorry, as a deposit, to pay off credit cards, installment loans, whatever it takes to get you to qualify. But mind you, this is a last resort. Okay, we're not looking to pay off debt unless we absolutely have to qualify for your dream home. Must be recorded in second lien position. This is the California Dream for All shared appreciation loan. It's going to be in the second lien position. It can't be a third. Okay, it can't be a first. It's going to be a second lien. For all shared appreciation loan underwriting guidelines and details, be referred to here. Okay, moving on. Now the fees. There's no loan price adjustment when using half a preferred. Let's see here. Lender allowable fees. They are going to charge a $250 fee for the second on this one. These are typically for my access. Let me go ahead and see if there's any. Yeah, of course, there's no California Dream for All guidelines on that. But essentially, they do charge an extra recording fee, and they typically charge a lender cost of $250 for adding this second California bond on there. It's something that we have to worry about. And then, of course, we are going to disclose this on our loan estimate, so that way you can review all of the charges that go through it. So that is basically all of the information for the California Dream for All guidelines and what you should expect to qualify. Now, let's go ahead and go to the program and let's go to the program and then see how we can apply, because that's important. And we want to make sure we apply. Okay? Apply. I want you guys to be able to be ready for this. Okay. So registration will open on February 24th, to March 16th, 2026. Start preparing now. What does that mean by preparing now? Get your income documentations, get your asset documentations, because we still have to prove your deposit, where it came from. Okay, unless you're not going to use it for closing costs, which is very possible. If you're not going to use it for closing costs, then it's not going to be that big of a deal. But typically, if you put down a deposit and you got to use it for closing costs, they're going to want to source it with 60 days of assets statements. So 2 months of bank statements. So incomes, documentations, bank statements. Get your credit ready, meaning let's pay off unnecessary debt that you may have, and take your home buyer's education. There's free options out there, and there's links to those free options here. If you have if you are looking for that free home buyer education, send me a message and I will forward you over the information on how to take it for free. If not, you're going to have to take it from eHome. It's $150. But if you're already in the process, you have an offer accepted, and you have your voucher, there's really no time to waste. So you're just going to have to pay the 150 and just get it done. Okay. Don't dilly dally on this situation. I've had a borrower who made it so that we could have closed a week earlier, right? We were still 30 days in closing, but we could have closed much earlier if they had taken the homebuyer education a little more seriously. Of course, they were trying to save some money, so I don't fault them on that. But essentially, that's kind of what happened. California Dream for All Shared Appreciation Loan Program highlights eligibility, documents needed, and shared appreciation. Come to this area, which is the Cal Half a Dream. You could search for it on Google or whatever, but just understand the registration is going to open on February 24th. I want you to be ready. And over here is going to be how you apply. Don't worry about finding your loan officer. Your loan officer is right here. If you're in California, West Shores Financial, Isaac Grajeda. I'm the vice president of mortgage operations over here. If you have any questions, please reach out to me for anything. There's nothing that I can't support you with. I can do most of anything. Registration will be open from February 26th to March 16th. Start preparing now. The program highlights is it offers up to 20% of down payment or closing costs, not to exceed $150,000. We went over that maximum. In Los Angeles County, it would be right around $982,000. Okay, that would be the maximum you would be able to use for this benefit, and then they would require more down payment, I guess, if you were to go above that. But get excited. 982 is a good number to work with. Personally, I would look for properties at 950 and then use about 30,000 for your closing costs, and that's how I would structure it. Okay, offers up to 20% down. Home buyers must register for a voucher. A randomized drawing will select registrants who receive the voucher. This will not be first come, first serve. This is a lottery system. This is first-time generational home buyers. Eligibility: one borrower must be a first generation home borrower. So you can have multiple borrowers up to an income level of 168,000. One of them has to be a current resident of California. All borrowers must be first-time home buyers. Income must meet the CalHAFA income limits on the county you're in. Let me go ahead and click on that again. Make sure that this is right. Yes, 168,000 for California Dream for All. Boom. Okay. And California Dream for All lender pre-approval letter. So this is for us. This is for your lender to fill out. I can do this for you. Boom, and set you up. I have the approved lender. I will be the company, and I will be the reason why. We'll need a passport, a driver license, state issue ID, military ID, permanent resident, alien card, visas, employment authorization documents to qualify. We just need one of these. We don't need all of them. Foster care documentation, if applicable, if you were adopted, because they want to make sure that your parents weren't owners of a home, so that you qualify for the first-time generational home buyer. The DFA voucher application will require information on both parents for the designated first-time generational home buyers, including name, date of birth, date of death, if applicable, current address, proof of parent relationship, birth certificate, adoption paperwork, and you can sign up for e-news right there. So we went over how you qualify for, or how the shared appreciation loan works, but it is a shared appreciation, right? 20% of that down payment is going to be paid back to CalHAFA whenever you refinance or you sell the property. You can refinance for a lower payment if you want to, but the lower payment will have to come from CalHAFA and their rates right here. So you can refinance with CalHAFA at a 6% today. A year from now, it's going to be lower, in my opinion. And 2 years from now, in my opinion, it's also going to be even lower than that. So you'll have a chance to take advantage of lower interest rates as they come. The 20% is paid off, and then also the amount of appreciation you've had. So if your home, again, goes up $100,000, $1,000 in value. When you go to sell, 20,000 of that is going to go back to CalHFA along with the payoff of what you borrowed initially. Okay. And if you refinance, they're going to want 20% of the appraised value that you used to refinance the whole loan. And that, let's say you're going to pay off your CalHFA, your Fannie Mae HFA loan and your shared appreciation loan. You're looking to pay that off in a refinance, and just so you don't have to deal with that anymore. Then you would essentially pay 20% of the appreciation of the appraisal report that they give you, and whatever you borrowed initially. Okay, so please, if you have any questions, please reach out to me anytime. If you're looking to do an woo, that's funny. Let me go ahead and close off my, there we go. Stop screening. Okay. So if you have any questions, please feel free to reach out to me anytime. And also, if you're looking to apply for down payment assistance programs, and even if you don't get this CalHFA Dream for All, we have amazing down payment assistance programs. We have down payment assistance programs you don't even have to be a first-time home buyer for. Okay, so if you're looking to purchase a home and you don't happen to be a first-time home buyer, or you sold your property last year and you're looking to purchase another property and get into the game again, please apply. Right here, right now is where you're able to submit an application. I'll reach out after that application has been submitted, and we'll work together to make sure you're prepared for not only the CalHFA Dream for All, but for whatever program that suits you the best. My name is Isaac Rajeda. This has been our CalHFA Dream for All webinar, I guess, or presentation. And I really, really, really would love to be your loan officer. Please consider me, DM me, comment any questions that you may have, or apply today. Thank you so very much, team. Thank you so very much for humoring me, and I hope you have a great rest of your day.